Hello, folks. Welcome to State of the Market. This is David Russell, Global Head of Market Strategy at TradeStation. It's great to be with everyone. Hope everyone is having a great 2026. Today is Monday, January 26th, and the title of our webinar is "It Buyers Move Beyond Tech." Let's see if we can something happen here. Here's my little slide. Let me start this over again. Let me just start this over. My disclosures, great. So today, I think as we look overall at the market, we see that we have a situation of the market has been taking on this kind of very much of a broadening sort of stance. It's become kind of anything but mega caps to a certain extent. Today, for example, we have some news on Google and Apple collaborating with AI, and nobody really seems to care that much. Of any of the mega caps, one that seems to have at this time the most kind of um, you know actual narrative or something going on is Tesla. Now, before we get on to that, I want to remind you guys that we are going to be doing an event called Derivatives in Focus in-person event down January 26th at Trade Station's headquarters in Plantation, Florida, which is near Fort Lauderdale, if you don't know that. We have a QR code here if you want to check it out. I will be one of the speakers along with Jesus Nava and some of the others. So you want to check that out. Please, oops, show you the QR code one last time. They had this animation. Let me pause it. You can see that QR code one last time if you want to check it out. And join us on Thursday, January 26th, 2026, which is a little more than a month from now, a month and a half. Hope everyone is having a great day here on a Monday. Here are the standardized returns of ETFs we're going to be talking about. So it's a very interesting overall market. We were just trying to have an inside day, and we kind of inched above to a new all-time high on the S&P. And I'm going to show you some of those things here. So these are standardized returns. I want to just very quickly actually show you here our MT Breadth workspace. We use this for our other webinar, our market trends webinar, and we share the link if you want to check those out. But what is interesting here is this is the advanced decline line on the New York Stock Exchange. It's hitting a new all-time high today. The advanced decline line on the S&P is not as high, but it's still near the highs. You've seen more stocks making 52-week highs, things like that. So a lot of signs of strong breadth overall, and I think that's kind of important to realize. That was something that was interesting, and I think right now what's grabbing my attention also is this daily chart of the S&P 500. And this is our trading view. Now we have this down here. We call this basically the moving average speed of the 50-day moving average. I want to point something out. The 50-day moving average here has, when this drop occurred in mid-November, you can see here that right now um, that is still within the last 50 days. If we actually, this little thing here I'll actually show so you can see that this is the trailing 50-day period. So if we move this measurement tool right after that drop, basically what it says is by the time we get to around January 6th, this history will no longer be in the trailing 50-day period, roughly. So I think it's important to realize is that this 50-day moving average is kind of flatlining here. But if you look at other moments in time, you can see the market rallies and it kind of just barely stays green and then it can extend. We've seen this on multiple occasions. Like if you look back in I'd say early 24, late 23, same sort of thing when we kind of get to this point, if it kind of turns slightly green and then it extends at different times. You can see also here, like in April of 24, you can see how it kind of, flattens for a bit, stalls, and then you get an extension as it starts to rise again. So with the calendar looking forward, I think it's important to realize with earnings season and all these other things happening, that this does maybe create some potential in the daily chart, which is the intermediate term measure, the 50-day moving average, for this to actually reaccelerate in the coming days. That's a potential thing. I would say the coming weeks, really. So I mean, remember, once we get to this period in early February, this a lot of this weakness will start to be fading out of the 50-day moving average. So I think it's an important thing to realize because we have a situation now where in some ways the stock market has kind of it's like a car you pull into the left lane on the highway and you're still going 60 miles an hour, hasn't accelerated yet, but it's cleared to a new all-time high. It's above the 50-day moving average. We have strong breadth, and then you look out into the future, a lot of things happening right now I think are also possibly conducive to continued strength. So this market in some ways has it here the potential for potentially some extension to the upside when you look at things like the 50-day moving average, look at the outlook for earnings we're going to get to in a minute. The other thing I want to just quickly mention also is that the VIX is just kind of staying pretty low here, just pretty much muted under 16. And that also creates an environment where the market overall might not make significant moves, but individual stocks will. So remember, we have our volatility cycle. We've cited this in the past. And right now we are in a spot here with the VIX having fallen, less correlation, more stock picking. And what does that mean? It means the indexes in many ways are less the sort of area where people are going to see the opportunity, and more individual stocks is going to be where people see the opportunity. It's a stock pickers market. Indexes are less important. So we're actually going to talk about a few stocks in a minute here, but I want to just kind of lay the groundwork for that to kind of realize that when we're in a part here, a time when the market has seen the VIX come down, the indexes can make smaller moves overall, and the individual stocks can do more outperformance. So it makes more sense to start looking at the individual stock level. And then it's just an important thing I think to realize overall. So now look at the S&P here in the weekly chart. You can kind of see this. Now I'm going to just go to some other data that I personally track myself when I look at I go to S&P Global and I get some of this data and I kind of look at it. But I think it's really interesting to realize is right now the S&P 500 is trading at 26 times the current earnings. And let me be clear, current earnings for the S&P 500 now is still Q4 or all of calendar 2025. We're not yet done with earnings season. So for now, we're still valuing the market based on earnings from the end of last year because we're going to be getting those in the next few weeks. So right now, based on estimates, the S&P is trading at about 260. Right now, it has about $263 per S&P share of earnings power, which is a PE ratio of 26. Now, for the calendar 2026, the S&P is expected to earn $310. So our current PE ratio is 26 times. We're trading at about 22 times forward earnings on the S&P. But if we get to the end of the year, then what happens is you basically could see the potential if we go to the 26 multiple that we have now on 2025 and you project that multiple 12 months into the future and you say the S&P will be trading at 26 times trailing earnings as it is now, and those earnings rise about 15% in that time to $310, the S&P could be arguably at 8,200. So this is just kind of some of the forecasts you will look at. If you assume that the multiple stays where it is, and you assume that the earnings that are projected stay where they are, then that is the situation that you could have. Now, the thing is that people might also see the potential for both of those numbers to move in a bullish direction. Why? Well, if inflation comes down, if interest rates come down, that could lead to multiple expansion. The other thing is that earnings often surprise. They could surprise to the upside if they do surprise to the upside. So those are things I think we have to put out there. When you look into the future, these are the numbers that big institutional investors look at. These are the numbers that are underlying the market. So I think it's important to realize now that from all the gloom and doom, Jerome Powell and Trump and blah, 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 at the end of the day, when you come back and you look at the actual foundation under the market that people are going to look at when they judge stocks, those are the things that are in effect right now. And I think we have to realize that it is a relatively positive environment. Earnings growth is expected to accelerate. It's going to be, according to FactSet, it's going to be double-digit earnings growth all 4 quarters of this year, which means starting in April, we'll start to see those numbers for the quarter that we're now in, ending in March. Remember, the numbers we're going to be getting in the next few weeks are for the December quarter. The other thing I think is important to realize is that CPI, like it says, inching lower. So I want to just throw out an idea here. This could be like 2022 in reverse. In early 2022, we saw basically things like value, financials, and these sort of things were breaking out in early 2022 when the market kind of entered that bear market. Early in the year, we saw strength in things like financials, and they significantly outperformed tech and growth and things like that. And in many ways, that pivot to value in early 2022, late 21 was bearish, and it corresponded with the market having this pullback and this essential kind of bear market because at that time inflation was still rising. But here's the key thing. I think it's important to realize. So in some ways, this year we are now seeing a shift to value. We're seeing a broadening shift away from mega caps. So it looks like early 22. However, we now have double-digit earnings growth. In 2022, earnings fell 11%. The other thing is that at that time, inflation was still rising. And in 2022, inflation did not hit its peak until June of 2022. This year, we're seeing the opposite. This year, we see things like housing costs and everything else easing. So I think we have an environment here where in some ways it looks like 2022 with people selling tech, going to value, selling mega caps and all that sort of thing. However, inflation and earnings and interest rates could be pointing in a different direction. I think it's an important thing to realize here because this environment in some ways could simply see an environment that is potentially positive, but in a different way than we've seen, where it's less about just pure AI growth and more about things like financials and industrials and M&A and things like that. So look here at, for example, the Russell breaking out to a new all-time high. This to me actually might be a pretty significant thing. I think, the Russell has been in some ways stuck in this level for a while. And I mean, if you look at some of the different things that have been happening in the market, if you look at something like silver, which has been going really crazy here, but look at what silver looked like about, in the middle of the year. It basically had hit that peak from back, after COVID, and it was this long basing pattern. Now look at the Russell right now. And what I mean, it's not terribly different. So you have something that goes to a high, stalls for a period of years, and you get this like long consolidation period. And according to some people, as the Russell small cap earnings are supposed to grow like 20 to 30%, like twice the speed of the S&P 500. So I want to just kind of point that out here that this could be a year when the Russell finally wakes up. It's had so many false starts. It's like, Lucy in the football. People think it's going to go and it has a total rug pull. But this year, I just want to point out, we've seen things like this in silver before. And I think you just have to realize is that charts do things like this. And I want to kind of throw that out as something to be aware of in terms of, looking at the Russell here, the Dow breaking out to new highs. Dow Jones Transports also, on the indexes here, you can see Dow Jones Transports kind of breaking out to new highs as well. This is all very much of a kind of cyclical value story right now. Now, the NASDAQ overall, it's sitting here and with earnings and everything coming, I mean, this is something that has that potential to accelerate, but at the same time, it really hasn't done it yet. And there are some signs of it just kind of languishing here. So I think people have to realize is that we have seen a pattern here of people selling the large growth. And this could be simply be a situation when it's not like a significant sell-off. It's simply a period of lagging underperformance. And then maybe in 1 to 2 quarters, middle of the year or something, then suddenly maybe people, the whole rotation, things happen kind of by quarterly patterns. And right now, the kind of quarterly action we're seeing now is not in favor of the mega caps, it's not in favor of the really large growth. It's in favor of things like financials and industrials and materials, these smaller cyclical parts of the market. We're going to be getting to that, of course. So just remember a few things here. Now, I actually forgot to remind you guys, go to tradestation.com, scroll down the page, and then click on, actually, no, not down the page, just go here to Insights, go to Market Insights. And on this page, when we have our blog post, which has a bunch of information today about what's been happening in the market, and this has a picture of houses on it. Broad rally as buyers move beyond tech stocks. I think it's important to kind of realize is that housing last week was very strong, and we've been saying that in many ways the housing market. I think the real thing about it is that home builders are going to have to compete with existing. People are going to be selling existing homes. They're going to have competition in that area, and from my perspective, when you look at the overall kind of balance of things, that could be a headwind for builders overall. The key thing we want to take away from the housing market is as houses transact, prices will fall as people buy and sell houses, as they move, rents will ease. And that right there is about 36, 38% of CPI. If we get shelter continuing to come down, in many ways, that is such an important thing for interest rates. And I think we just cannot forget how important shelter costs are and the fact that they are in a pretty steady downtrend. And if that downtrend continues, that could be something that actually creates that sort of more dovish central bank environment. So look here at the upcoming events. I think it's important to realize that. So basically, we have CPI tomorrow morning. That's pretty important. But after that, we might get a Supreme Court ruling on the tariffs. That might come on Wednesday. We don't know. I mean, you don't even know when the Supreme Court issues statements. I mean, I can't believe we're watching the Supreme Court, but this is the world we're in. Speaking of the Supreme Court, speaking of the Fed, now everyone knows Sarah Jerome Powell and all this stuff with, charges or whatever probe. We all know this stuff, so I'm not going to get into it. But something else I want to put on the people's radar to be aware of is on January 21st, which is Wednesday of the following week. So we have MLK Day on the 19th. Remember, the market is closed on Monday, the 19th, a week from today. But that week of MLK week, on the 21st, we have Lisa Cook has a hearing in the Supreme Court as well. That's another political thing with the Supreme Court involving the White House that I'm not going to get into, but it could be a catalyst. So remember, just kind of keep that in mind. I don't have it in my article, but I was looking at and I want to remind people of all that. Now, also this week, another event this week is a JP Morgan Healthcare Conference. You might want to kind of look into some of the individual micro levels stories in there. A lot of companies that might be up or down for whatever reason on that. I want to just kind of point that out. So speaking of housing, today we did do a trading view idea. I'm gonna actually for now hide my trade station, but we did a trading view idea on open door to housing stock. Doing a trading view ideas here. You might want to just kind of check this out. I mean, it's an interesting. Stock had a dramatic move, but this is one of those kind of housing thematic stories. And people might want to kind of look at this one. This is a kind of high beta, volatile stock, but you know, given the sort of narrative and the sort of focus on something like housing, this company might come back on people's radar. It kind of reminds me of the way some of the quantum computing stocks traded. Um, Okay. Now, I want to just really quickly just show a few stocks who return to the overall indexes. And I think Tesla is one that we have to be looking at here. I'm going to, for now, just I think the key thing is with Tesla is that, a lot of bad news is now in this name. In terms of weak deliveries and China being weak and all that. And, I think as we move forward, robotics are going to be a story. And, I was just looking at some of these narratives that are taking shape in the future. And I mean, this is something that's going to be not tomorrow, but it's also, within the next period of time people can see. But there's talk about like, SpaceX going to Mars and stuff and using robots on Mars from Tesla. So there's a lot of things for people who are interested in growth. There's a lot of potential to get interested in when you look at a name like Tesla, when you look at things like robotics. I mean, I'll never forget, I remember in the early 90s, I used to go to an office and they still had a typewriter. And I said, wow, why don't they have a computer? And then 10 years later, they all had computers. Well, we're at a period of time probably where in 10 years, you're going to walk down the street and you're going to see a robot. If you went back to 1990 and you walked down the street, nobody had a cell phone. You fast forward 10 years, everybody had a cell phone. There's going to be a period in time here when robots become a mainstream thing. And that moment is not very far away. And I think Tesla is something that is so central to this story. So I think right now Tesla is a name that people are going to really be keeping on their focus here. And let me actually take a quick look here at the Fibonacci. If you look at this move, I mean, it did break more than 50% of the move, and I think it is kind of lumbering here. But I think we just have to realize that this stock is now kind of chopping near these old highs, and this is, when people looking at long-term growth names, this is something of a cup and handle sort of continuation pattern for a large cap growth stock. So I think this is a name that people are going to be very much focused on. Now, another interesting thing today was Akamai had a double upgrade from Morgan Stanley. This company historically has done like web caching and things that at one point were high growth and they became very much boring, mature industry or mature vertical. But now they had this upgrade from Morgan Stanley, which is basically saying that they have this new cloud computing business. I want to just throw this out there. It's one of the big movers in the S&P today, AKAM. I would imagine it probably has not been on a lot of people's radar for a very long time. And it might be something also for that reason that people say, hey, wait a second, maybe this company actually has something happening. It's interesting here to actually look back and see this gap up on earnings. I don't know much about this company, but I want to put it on people's radar. Why? Because here we are in stock picking. And when we're in stock picking, that's when people are looking to pick stocks, like potentially a name like Akamai. So I want to just kind of mention that they're looking for individual stories now that otherwise might not be happening. Now, also something else that is happening is that uranium prices are moving up, and Kamiko is a name people might want to have on their radar. CCJ. We've seen this big move in things like silver, platinum, which we've been talking about a long time ago. And I think now people might also want to realize that uranium is in a spot where, everything with nuclear energy and all that sort of thing. Um, it's a metal. It's not a metal like, that is common, but it's still part of the metals commodities trade. I think people right now, might want to be going back and thinking about some of the potential things in uranium. And CCJ is one of the main names in that area. And another company that's interesting that had some bearish news, but Synopsys, which is a semiconductor software company, people might look for it to fill into this gap. Now, one of the name I want to mention, which reports earnings tomorrow, is Delta Airlines. Now, transports have been strong. Delta Airlines here consolidating above these old highs. I have Option Station Pro here. I just loaded this up on the show. If you look at the expiration this week, a person might look at something like the 74, 78, call spread potentially. And that right now is going for around 76 cents. If the stock were to close at 78 at the end of the week, if it had strong earnings or something, that would be over 400% potentially. So I'm gonna just kind of throw that out there as a name that, these airlines have been strong, and it's just kind of sitting and consolidating here. And I mean, um, I think it's just something people might want to kind of have on their radar. Transports are breaking out, industrials are very strong right now, and this name is kind of just sitting above. I'm not sure if it's how high it is long term. It might be an all-time high, but it's definitely a multi-year high that it's consolidating this level from back in early 2025. So that's DAL. Those are the main individual stocks. Now we're going to turn to the indexes, as we always focus on this webinar. And I think it's here important to realize that we basically have the S&P on the weekly, the series of higher lows. And I think it's really important if we look, going back to the S&P here. um, Now, I'm not going to actually draw these. I'm going to just look on this really quickly. This chart doesn't have much else on it. But if you basically look at the market when it broke out above where it was here, this low that we had in mid-November was a 50% retracement of this breakout move. Then, if you look at the rally from here to here, this was a 50% retracement. Then, if you look at the rally from here to here, this was a 50% retracement, roughly on all three of them. I think it's an important thing to realize that we've been holding 50% retracements, making higher lows on the weekly chart. This is, I think these are sort of patterns that are objectively observable. So here we also have, it's interesting to see that here we hold 6,500, here we hold 6,700, here we hold 6,800. And here last week, look on the daily now, what do we hold? We hold 6,800. So I mean, 6,900. I'm sorry. We're just baby stepping higher, holding 6,800, holding 6,900 after we hold 6,700. So again, these are just stair stepping higher. And if you take a step back and you really look at what we have here, you can actually see that we essentially have a 2.5 month consolidation pattern that we could be escaping from. And because we've been consolidating for 2.5 months, that 50-day moving average is kind of inert. But this is what I'm talking about. There is that potential. The car has pulled into the left lane and it's still going 60 miles an hour. That is something I think we might be looking at here. So want to just kind of point that out. MACD, I don't have it on this chart, but MACD has been rising. If you look at I like the 10-day simple moving average. We're holding above that. Last week we held the 8-day exponential, and we bounced above that. So I think all these things are important just kind of to realize when you look at the overall S&P. So that's the S&P, and like I said, on the weekly, it's pretty tight. Now, it's interesting. The S&P might actually lag the Russell. It might lag the Dow. There was a time when the S&P was leading all the other indexes, which was very strange. And in a new year and everything else, when you see this strength in things like the Russell and everything else, I want to just kind of point that out. Is that the S&P might be the kind of big, boring, lumbering thing, and people are focusing on these other parts of the market that have more overall kind of cyclical buzz and excitement. And so here we have the Qs also in this type pattern here. And, from my perspective, this might be a spot, though, that even with the things I just said, this could be a spot when people do look for that potential of the Qs to extend. So from my view here, there's really nothing super clear, and we're not that far away from the high. But I think right now there is the potential that this does accelerate to the upside. It isn't confirmed yet. We don't actually have it. If you look at things like our changes, go here over here to our workspace. I'll show you really quickly. If you look, for example, here at our key ETFs and something like our 21 day, you can see that, on the index level, you can see the Qs are the laggard in the last 21 days. In the last 63 days, the Qs and the SPYs are lagging the Russell and the Dow. So this is exactly what I'm talking about. We don't really have the confirmation, and I think it's hard as it is to accept. Sometimes you actually do end up when everyone wants to be in the Qs, and the fact is that that might reassert itself and this might break out to the upside and just rip higher. And if it is, people might want to react and see what's happening. But at the same time, it isn't confirmed yet. So I think this is something that I'm watching as a potential to see if we actually do see the large caps and the Qs reignite. But at this point, there's no confirmation of it happening. It is very tight here, though, so I think it should not be ruled out as something that's a strong possibility, especially as earnings come. So the Dow here is also just kind of it's broken out to new all-time highs, and from my view, this is something where people might have a degree of kind of looking at that recent high there as well. I think with some of this stuff we're seeing here with the financials and everything else, calling for a cap on credit card rates and going after Jerome Powell, financials have had a good move here. The Dow is big in financials. JP Morgan reports, I think, tomorrow morning or Wednesday. Look at my article and I say, but the key thing is that that might cause some kind of weakness in shopping here. So from my view here, essentially we do have on the weekly pretty much a confirmed breakout in the Dow. However, at the same time, people might look for some degree of chopping and consolidation. When you look at how this has traded in the past, it goes through a high, it can move sideways for a few weeks and then continue. So, from my view here, this might be something where it makes more sense to look for more weakness in something like the Dow and the financials. Get through earnings. Maybe the bears will try and hammer it down a bit, and then there might be some more opportunity. The Russell, on the other hand, here, I think we seem to now have a confirmed breakout in the Russell, and so I'm just kind of, pretty much just seeing here, and I think we have to realize that you know, one or two down days might give opportunities, but at this point, we might have the thing that people have been talking about for a long time, which has been like, a total frustration for many years. People have been saying the Russell's going to rally, the Russell's going to rally, small caps, and they don't. But of all the technical patterns I've seen so far, this one seems to be, in some ways, potentially the clearest signal that we might actually be getting that situation right now in the Russell. So I think we should not look past the fact here that the Russell, having rallied up and now held that level from early December and staying above that, from my view, as long as people, as we see things staying above it with CPI tomorrow, if that number is cool, people this might have more kind of potential for extension. So I think we want to kind of bear that in mind. Now, the 10-year treasury yield here, it jumped today with, Jerome Powell and the Fed and all that risk and everything else. However, it has stayed below 4.25. And, it's staying here at like 4.20. And from my view here, I do think that there are definitely things that are, with the stimulus coming and these, apparently people are going to get significant kind of, what do you call them, refunds and stuff on their income tax and stuff like that. There are the potential for some of those things to kind of create some cyclical juicing in the economy. And there's a good chance that we don't see yields go significantly lower. But they look like here, like they are kind of stuck. And, if we get a cool CPI number, if we get some other things where whatever happens with the Powell thing goes away, Congress, however they respond, there's things happening right now politically and everything else. If CPI is cool or if something else happens, you know, from my view here, there is the potential that the yields don't move much higher and they inch lower, and that can be a potential positive here. Now, the dollar index I've been watching, and I think we have to look if we're going to get the continuation of this longer term downtrend. And I'm don't have much of a clear view on it, but I think it's important to realize that this might turn into some kind of breakdown. But overall, I'm not overly sure what to think. And one of the reasons why I'm not overly sure what to think is look at the GDP now. I'm sorry, GDP now from the Fed. I mean, this was last week, and basically the GDP had this huge number on the trade deficit narrowing significantly. I mean, a lot of the data last week, if you look at my article, was relatively positive. If you look into the different things with the ISM numbers and everything else. So I think right now I kind of break it down here, but some of these things are pretty positive on the economy. So I mean, I think we have to be open-minded to the potential of more downside in the dollar, and there could be people pushing it if it happens. But at the same time, there are fundamental reasons why it may not. So I'm just watching here, and I'm just kind of seeing that this has the potential to have an extension lower. And if it does, I think that that's something people are going to react to. But also, it's not really confirmed in any way yet, and it could just remain kind of drifting here for a while. Now, materials are going back; they're near the old high here, And from my perspective, this might be something that with inflation coming, we might see one last kind of jump in materials, one last sort of if say we have a cool inflation report, one last jump in materials, one more jump in precious metals, one more drop in the dollar, and then it's kind of the return to normal of things like earnings and more of that kind of focus on the earnings story and less of a focus on the overall macro story, which is in the weak dollar macro story. And we'll just kind of point that out here. This might be something where we see a period of consolidation here, but there could be a breakout in materials. And I think if we get that, that's something worth paying attention to. And what we've been seeing, this is the XLB, but what we've been seeing with things like small caps would also match that. Small caps and materials are somewhat correlated, and we actually could see a move here that kind of continues. So I want to just kind of point that out. You know, Here we have communications, XLC. Now, the problem with XLC in some ways is that it has been, bullish, but overall, it's mega caps and it's not cyclical growth. And so I think right here, and a lot of the actual strength recently came from all this stuff with Paramount and Warner Brothers and this whole M&A buzz. So from my view here, XLC is kind of stuck here, and I think it does have overall a bullish chart, um, on the weekly. But when you look at the actual internals of the market, this has not been a part of the market people want to be in. It has not made a new high since September. Let's just bear that in mind. This is the beginning, in some ways, of a warning sign of something not being still under accumulation. And I think it's important to realize that here. So, from my view, this is something that might actually, if it doesn't break out soon, this could turn into more of a range bound period. Not to say it's bearish long term, but it could be something where it has a quarter or two of consolidation as people focus on things like these other cyclical parts of the markets. XLE, very quickly, I'll just mention energy here is kind of stuck at this level. And I got to say right now, the thing with energy, I mean, it's the if the Venezuelan thing doesn't play out in a bullish way for the big oil companies, that's a risk. And honestly, it's hard to see how this idea that they're going to just go rushing into Venezuela and invest in Venezuela. I mean, to me, it doesn't seem massively likely. But the other thing is, if we don't get, I mean, some kind of crisis or war in the Middle East, oil also has downside risk. I mean, there's been buzz about new stuff maybe happening with Iran or things like that. And I think that has remained on the table in a lot of people's minds. And if for some reason that situation does not materialize into something, that's bad for oil, bearish and war or something like that, then I think oil overall has a lot of geopolitical risk that still is in it. So I think we have to realize that about energy here. If things don't go badly, then they could go badly for oil, and that could be bad for, that could be a situation for XLE. So I think right now we got to realize XLE is really stuck in this range, and it has now a lot of good news priced in, or I should say bullish news, things that are potentially bullish for energy itself. XLF here was very interesting to kind of see the bullish news in some of these companies. And I'll tell you the one that really grabbed my attention was Moody's MCO. It's not an actively traded stock, but it had a credit upgrade back here in December and then a big, stock upgrade. You know, People are looking for this to basically become to benefit from the increased debt issuance and stuff. And I got to just say, if you look at this chart and then you look at Micron back here when Micron started running, they don't look that different. And remember, Micron was the whole DRAM, the whole memory chip and everything else. Well, I mean, debt issuance and M&A and things like that are a story that's coming the same way the shortage in memory was. So it might not be as dramatic, but this is something overall that could have ripple effects. And I think it's one of the reasons why financials overall have an interesting narrative. However, there is this kind of near-term sort of uncertainty. So from my view, here we actually see the XLF holding some levels, and this kind of weekly low. People might look for it to kind of drip down, kind of break down a little bit more under 54 and a half. I think right now with earnings and things coming, it's a little bit uncertain. But overall, this has been something that has been essentially kind of confirming a breakout. And also, it's like it pulled in the left lane and it's going 30 miles an hour, or maybe it's going 50 and it needs to go to 30 before it then accelerates. But the key thing here is that this is something where there are a lot of potentially positive things for financials. And I think we have to realize that and see it's on the chart. Now, industrials XLI have very much of a confirmed sort of breakout here. We have things happening with cyclicals, with transportation stocks, with defense stocks. We talk about some of that in our article. And I want to just mention that all those things are continuing to kind of play out. XLK is similar to the Qs, and I think here there is a little bit of a risk of this getting stuck under 148. There's this kind of high back here in November. It hasn't made a new all-time high since October. Overall, to me, this is something where it could break out and extend, but it also could have that period of consolidation, kind of like XLC. We have to be on guard and prepare for it, and just recognize that the charts are telling us that that's a potential thing, and if it confirms that way, it could actually be telling us that tech is going to, potentially be, could potentially struggle for another period of time as people focus on these other areas like industrials, maybe materials. XLP, consumer staples. This one has space to go back up its range. I think you look on the weekly, we've talked about this range for a while. We had talked about how it was going to get sucked down that range, or it could get sucked down the range, and it did. Now people might look for it to run back up the range toward 84. That's about all there is to say about XLP. XLRE, real estate here. I mean, this is something now that has this kind of downtrend that it's kind of stuck here. Nothing really in this sector is very interesting to people. The economy accelerating, when you have GDP doing something like this, when you have all this other stuff happening. I mean, this is not the kind of sector people are going to be very interested in right now. Has refinancing risk at this moment. So from my view here, this is something that people will probably look for it not to do much of anything for a while. Utilities also here have that sort of, this kind of bearish trend overall. They have broken out to a new all-time high, but at this point also, I think we have to just kind of wait and see them consolidate and see what else happens. This might be something more that people are focused on, like as we go toward the next Fed meeting, like maybe the end of this month or something like March. From my view right here, these have pulled back, but they're also just not the kind of thing that people are interested in when they're looking at an accelerating an economy and things like that. Healthcare here, stuck at the top of this range. However, this might have some breakout potential when we get into some of the earnings and things like that. I think healthcare is another area that has actually, a lot of potential interest in it. It's like financials. It's underperformed for a while, but it's a real sector with real growth. And honestly, I mean, it's one of the driving parts of the American economy. One of the driving parts of the labor market has been healthcare, and the industry, the stocks themselves have not been that strong. So this might actually be telling us that healthcare has some potential here. And XLY, consumer discretionaries, we had talked about this being very tight, and now we should be getting this kind of confirmed breakout with Tesla and everything else. So I want to just kind of point that out. So I hope everyone has a great day. We'll be back on Thursday with market trends. Don't forget to check out our article. Don't forget about CPI in the morning. Don't forget the potential tariff news on Wednesday. Hope everyone has a great day, and I'll see you on Thursday. Thanks a lot.